Hey there, students. My name is Nathan, and I am a Chegg tutor. Today we're going to be talking about the allowance method. Now, the allowance method is the opposite of the direct write-off method that I discussed in a previous video. The allowance method is a more accurate way of recording bad debts. Now, bad debts is when you expect a customer not to pay you in cash for a previous sale. Now, the reason why allowance method is more accurate is because it conforms to GAAP under what they call the matching principle. So the matching principle means that in a period of sale, you must match the expense associated with that sale. Every sale, there's going to be an expense associated with it, right? It takes money to make money, essentially. So you have to go ahead and record the expense in the same period as the sale. And same with bad debts. Bad debts is an expense, and so you got to make sure you match that expense with the related sales in the same period. So on the left side here, I went ahead and talked about the allowance method a little bit. So I'll continue on that. Once again, you estimate bad debts in the same period of sales. And these are estimates, so they don't know exactly what's going to happen. Like the direct write-off method, when they deem that they're not going to be collecting that cash, that's when they record it. But under the allowance method, you actually make estimates, usually at the beginning of the year, to see exactly what you think you're not going to receive in cash later on. So usually they use historical analysis, and these estimates are a percentage of receivables or a percentage of credit sales. So these companies look to their past history and see exactly, based on historical analysis, they suggest about, let's say, 4% that they're not going to receive in cash. And that's just based on past history when customers haven't paid them. Sometimes they use an aging method where they actually age receivables. So the longer the receivables are left unpaid, the less likely they're going to receive that in cash. So the longer the time goes on, the less likely they're going to get paid for those sales. So that's another way they can do it. They can estimate it as a percentage, or they can use an aging analysis. So when they estimate these bad debts, they record what they call an allowance account. This allowance is just basically an estimate up front of what you think that you won't collect during the year. They just create that in advance, kind of like as a precautionary measure, just to say, okay, most likely we're not going to receive this in cash, these sales, so we'll go ahead and create a little allowance account that actually will offset our accounts receivable. When I mean offset, it's the opposite, so that's what they call a contra account. So that allowance account you actually deduct from your receivables, because you expect not to receive a portion of those receivables. So you set up that allowance account and you deduct it from your accounts receivable. Once again, this method does conform to GAAP since it adheres to the matching principle. And here, like I was saying, accounts receivable minus allowance for doubtful accounts is what they call net realizable value. Net realizable value means what you expect to receive in cash, right? You have your receivables, and then you have that little allowance account of the estimate of what you expect not to receive in cash. You deduct that out, and then whatever's left over is what you expect to receive in cash. So this is a very tricky concept. A lot of my students have a hard time with it, but I come up with some simple methods to help you remember how it works so you can easily attack problems on exams. So let's go ahead and take a look at a practice problem and see how you do. So here we go. On the right side, we have a practice problem. On January 1st, 2015, LifeWorks Incorporated had a debit balance in their allowance account for $2,500. So at the beginning of the year, they already had a balance in their allowance account, most likely from a previous year carried forward. Now during this year, 2015, they had credit sales of $400,000. Based on the company's history, they estimate that about 4% of those sales will be uncollectible. So customers will not pay for about 4% is what they estimate. What is the adjusting entry to be made at the end of 2015? So what adjusting entry must be made? Now this is very tricky, so just make sure you listen carefully. First step to attack this problem, you need to go and focus on what the balance and allowance account was at the beginning of the year. And I threw a curveball your way. This is very important. It has a debit balance. So the allowance account, the normal balance, the positive balance, is credit. That's a positive balance. But they have a debit balance right here. So why is that? Well, the main reason why is what we call write-offs. When you write off an account, you end up debiting allowance for doubtful accounts to remove it. That's what we call a write-off. Now, most likely write-offs exceeded their estimates. That's why they have a debit balance starting out. So we know that credit balance is positive. Therefore, if it's a debit balance in allowance, it's actually negative. So I'll just go ahead and start over here. We'll do something called like a timeline to show you exactly how this works. So we'll start on the left side here for January 1st, 2015. The allowance account has a negative $2,500 balance. What I call your beginning allowance. Negative 25. So start there. Now, during the year, they had credit sales of $400,000, and they estimated that 4% of those sales at the end of the year will be uncollectible. So what you're going to do is you're going to move that all the way over to the right. Again, imagine this is a little timeline here. So over here, you're going to have December, we'll just say 31st, 2015. And that's going to be your ending balance, essentially, in your allowance account. So ending allowance. And for that number, you have to go and calculate it. They said that it's 4% of their sales they expect not to receive. So 4% times 400,000. Let's go ahead and get that. Okay, so they expect about $16,000 they won't collect. All right, so you started with a negative $2,500 balance at the beginning, and you ended with $16,000. The question is, what is the adjusting entry to be made? What must you adjust, essentially, to get from negative $2,500 to $16,000? That's what they're asking. What is the adjusting entry to be made? Well, you just go ahead and subtract and figure out the number to get from 2,500 negative to positive 16,000. And if you do that, the middle number in between will be 18,500. So basically it takes 18,500 to get from negative 2,500 to 16,000. And that adjusting entry is also what they call your bad debt expense. So you must record a bad debt expense of 18,500 to get from negative 2,500 to 16,000. And that's how it works. So once again, they recorded that expense in the period of the sale, and that adheres to the matching principle under GAAP. We took our beginning allowance account, and to get to our ending allowance account, we just made a bad debt expense. And that's another way to say adjusting entry. What adjusting entry must be made to get from negative 2,500 to 16,000? Now you can also see bad debt expense. I like to tell this to my students. You can see it as like a ladder, right? To get over the bridge or climb the ladder to get from negative 2,500 to 16,000, what must be made? And you must have a little bridge of 18,500 to get there. Hopefully that was helpful for y'all today. There's actually a lot more concepts that go into this, including write-offs and reinstatements of accounts. But for this video, we're just going to talk about the basics of allowance. Maybe later on I'll record a more advanced video for the allowance method. And my little link is down here. So again, I am a Chegg tutor. So if you want to come visit me at this page and send me a message, I can help you one-on-one. Maybe you need some homework help or some exam preparation. Just go ahead and go to this link here. I go by Nathan G, and I'd be happy to help you. All right, once again, thanks for listening, and I'll see you in the next video.